So, Mark, let's start at the beginning. How did a Michigan boy, son of a Protestant minister, become sort of the preeminent black swan manager in the world, is specializing in tail hedging? How did that come to be?
Well, a lot of luck. So I had very humble beginnings, but I happened to get sort of under the wing of a Chicago pit trader at 16, 15 really. And I just kind of was turned on by this, and he sort of, as I said, took me under his wing and taught me from a very early age what it really meant to be a trader. But it was particularly lucky because this old corn trader had this very particular approach to trading, really unheard of, which was to take a lot of really little losses, a whole lot of little losses, and occasionally have a really big winner. And of course, this is completely antithetical, opposite of what most traders do. I mean, everyone likes to say, you want to have big win, asymmetric payoff and all that. But the reality is, you can see hedge funds, for instance, or prop trading desks, without exception, they're all negatively skewed. So they tend to print money most of the time and occasionally experience big losses. It's always been that way, and it will always be that way. It's because it's very easy to show alpha when you are negatively skewed, right? Even though you may not have any. So this guy taught me when I was 16 that the way to make money as a trader is to love to lose money.
Love to lose money.
Love to lose money.
Okay.
Hate to make money, love to lose money. And the idea was when you put a trade on and it goes literally one tick against you, by the way, none of this works for true investing when you're not in the pit or a market maker, which is what I'm talking about. So this is not supposed to be a lesson in investing, but I think it's important because this is really the reason I went on to do things the way I did, which is be massively positively skewed. But all this strategy was, for a 16-year-old, was when you put a trade on, it goes one tick against you, immediately take your loss. And that happens most of the time, right? But when it goes in your favor, you kind of let it ride. And there's an art to this, but that was the idea. And I always thought at 16, this very impressionable age, that the trading was doing that because I didn't know any better. So I, of course, now, even today, I do something that's very similar to that. It just happens to be in a, I would argue, more sophisticated way of doing it.
Would that have been the fellow that was the greatest influence on you, or there have been any other investors who have been a big influence on you?
Yeah, so this individual, his name was Everett Klipp. He was, without a doubt, he was without him, God knows what I'd be doing. And it was complete luck. But certainly, over the years, I would say, without a doubt, the biggest influence on the evolution of what I do as an investor has been, without a doubt, the great Warren Buffett. I mean, he has been the greatest, and I think, will always be the greatest. And his insights, I think, have been very important to how we go about risk mitigation. I mean, just very briefly, it's this idea that risk mitigation has both this defensive and offensive component. And he is the guy that, like Rockefeller, buy when blood is running into the streets. And this is the ultimate strategy. This is the ultimate value approach. But I think more than that, I write in my books that, tail hedging, for lack of a better word, the way I do it is sort of a cousin to value investing. And that is because, at least the way we do it, and that is because I think what's special about Graham and Buffett and the value investors in general is that these are really the only guys that understand that risk mitigation really should be a source of benefit. It's not just a source of sort of lowering the risk or like hiding away, when dark clouds approach, but rather it should be a source of, actually, it should be accretive to wealth. Risk mitigation should be something as a direct consequence of which you are actually wealthier later. And this is, of course, completely antithetical to the teachings of modern finance. But the value guys get this.
Yeah. So before we get to the strategy itself, you mentioned your book. And by the way, anybody that hasn't seen it, I really quite enjoyed it. And it came out right before this correction, so the timing couldn't have been better. When you wrote it, what did you hope that the readers would get out of it? Or at least one thing, the most important thing you hope the readers would get out of it.
Well, I'll tell you what they're not meant to get out of it, and that is they're not meant to get any sort of recipe on what to do. Not only is that because, things change. I mean, you can't put that in a book. I hope this book is around for quite a while, and that would be a waste of space. But also, so much about investment strategy, I think, is so personal. It depends on your situation, your temperament, and things like that. So and also people would just get it wrong. It's just hard. But so this is not a sort of investing guide. What I really wrote this for was to be this sort of logical, rational approach to thinking about risk mitigation, what we should expect of it, what our goals should be, sort of a first principles approach. And that sounds kind of lame, but to me, this is something that modern finance just really hasn't done, because the goals of modern finance are, I think, something that I think if people really thought about it, they would scratch their head regarding it.
So, actually, in your previous book, which is the Tao of Capital, you had this central theme. There was a strategy called Roundabout. Could you comment a little bit on how that has impacted your investing, and maybe explain what it is? Because frankly, it's been a while.
Yeah, so roundabout is really this Austrian economics term, Produktionsumweg. It's really the central idea of Austrian economics, though it doesn't get much consideration anymore. It really just the idea that entrepreneurial growth, capitalistic investing is about delayed gratification. So what it looks like is it looks like you're going left in order to later go right. It looks like you're taking a loss now in order to be more productive later. Of course, that's what capital investment is all about. It's about higher productivity later, but it looks like you're doing, if you're just looking one step ahead, it looks like you're doing something stupid, right? So that's what roundabout production is. Again, central tenet of Austrian investing. But it applies, I think, really to investing in so many ways. It certainly applies to the value investors. I mean, they are, in a sense, looking for things that are sort of experiencing this type of growth, maybe earnings growth because of capital investment. But it applies to what I do, too. I think maybe they'll be clearer as we go along. But impatience is important. Delayed gratification, deferred gratification is so critical to being a good investor, I think.
So just to bring you up to speed, earlier through the day, surveyed people who's uncertain about the future. It certainly seems people are less confident, less certain about the future today than the last time we had this conference, which was pre-COVID. So safe havens and investments that are safe havens are of interest and on the minds of the people here. So maybe you could share how you compare and contrast different safe haven investment or investment genres, and from the point of either efficiency or effectiveness of both of those various safe haven vehicles.
Yeah, so my general approach in this book is let's look at different risk mitigation strategies. Let's build them very simplistically through these sort of cartoon payoffs, and let's look at what their effect is, and the rate of compounding. I mean, the argument here that I'm making is that we should move away from this idea of sort of risk-adjusted returns or mean variances. This is what modern finance is all about, modern portfolio theory is about. And to me, risk-adjusted returns, that's the three most disingenuous words in investing. Because if you think about it, what are we doing with risk-adjusted returns? Again, the idea of modern portfolio theory is that we engage in risk mitigation to lower volatility. We don't need to argue about how to define risk, but let's just say risk or volatility. And in so doing, you also lower your rate of compounding, you lower your wealth. That's recognized by everybody. But as long as that ratio is going up, that expected return relative to your volatility or your risk-adjusted returns are going up, and you feel like you're doing something productive. Now, all of hedge funds, all of risk mitigation, all of capital allocation is really geared towards this. And I think we need to question this, because I argue that risk mitigation should not be the cure that's worse than the disease. And that's exactly what it is. I mean, across canonical risk mitigation strategies, now again, you could argue, well, you're saying this in hindsight, things could have been a lot worse. But I'm the black swan guy. You can't tell me things could have been worse. I mean, that's what risk mitigation is here for, right? But I'm still able to say that you could go back 120 years. There was a lot of things that we experienced in 120 years. And I could say that definitively that not only have the existing risk mitigation strategies, canonical risk mitigation strategies, not been cost effective, and that's really what I'm talking about here, costing you more than that which they are trying to protect you from would have cost you. Again, that's very ironic. I call this the risk mitigation irony. Why should it be that why shouldn't it be the case that by mitigating risk, it should be accretive to your wealth? You should be mitigating something that would have cost you more than what it cost you to mitigate that. And that's the idea of cost effectiveness. You don't hear this word cost effectiveness in risk mitigation, in portfolio allocation, and it's for reasons, because nothing is cost effective. None of the things that people do are cost effective. They pretty much all cost you wealth. And again, we could argue, so what does this mean, that you should just not mitigate risk at all? But no, but what it means is that you should at least be thinking about it in these terms. And even though different strategies aren't cost effective, we can kind of rank them by their cost effectiveness. I think people need to start doing
So
this.
could you maybe just even rank that for the audience? Just give them a sense of what safe haven or risk mitigating strategies you're even referring to.
Yeah, so, well, it's across the board. It could be, it's all the fixed income allocations, think 60-40 very simplistically, any allocation to various types of hedge funds, CTAs, gold, everything that you can think of, the things that people do, and people allocate to different things as for risk mitigation. They don't do it just because they'll think they'll get better return there and there and there. They do it because there's some kind of a diversifying, or as Peter Lynch says, diversifying strategy at play here. But again, what you're getting by diversifying in this way is you're making yourself poor. That's the cost. The benefit is lower volatility. You sleep better at night. But I think if people can just understand, literally, what even in this environment right now, and again, I'm talking about strategic risk mitigation. We can contrast that with tactical, which I don't feel should even really exist because it presumes a crystal ball, and none of us have crystal balls. If someone had a crystal ball, it contradicts the idea of risk mitigation in the first place, right? All right, so to answer your question, the way I approach this is we just look at different types of risk mitigation payoffs. I don't want to get too much in the weeds here because it's hard to do without the visuals. But looking at very simplistically sort of a store of value payoff, that would be a constant, whether maybe 5% real return in something, which you can't really get, but there it is. You could compare that to something that sort of has this sort of long at-the-money option-like payoff, that actually pays you to hold. So that would be like what CTAs try to do, for instance, maybe making 5% every year, except when in this case, the S&P is down 15%, in which case maybe you make 20%. That would be a great CTA strategy. And then the third one would be something even more severe, where you expect to lose a unit every period, make a 10-bagger when the S&P is down more than 15. And I create I call these safe haven cartoons, and we just look at these going back to this bootstrap, but so the details are important, but we look at these as if you had held these in all different types of scenarios going back 120 years, and which one of those are cost effective. So the standalone store of value I described, obviously that's going to always make you 5% real. That CTA-like payoff, the way the markets have been, that would have made you about 7% on average, that standalone safe haven. And then that I engineered this cartoon insurance payoff to make exactly 0. So it broke even. That's the way I kind of balanced the 10. Over time, average 0% return. And the surprising thing is the only one of those three things that are cost effective was the insurance. And that's surprising because it's the only one of those three that didn't have an expected positive return on it. So now you can, mathematically, it actually makes a lot of sense. Got to get a little bit in the weeds. When you think about compounding, which is the whole argument here, that we need to think about our compound rate of return rather than our arithmetic return divided by risk. We need to think just about our CAGR. And when you just focus on that, and why wouldn't you? Because when you maximize your CAGR, you're maximizing your wealth at any given point in the future. So obviously that's what you're supposed to do. This is another great lesson from Buffett. The CAGR is what matters. You care about compounding and all of the the ramifications from that. And the big ramification of that is, of course, is that the math of compounding is really weird, and it's such that the bigger your loss, the harder it is to get that back. Your returns are no longer linear. We could look at our returns, our account statement at the end of every year, and we see linear returns on there, just plus, these are just linear returns for the year. But in fact, you need to think about those non-linearly because the math of compounding is such that you experience them that way. This is not esoteric math. And to just give a very quick example of that, we all know that if you lose 50% one period and you make 100% back the next, you're at 0. Right? So you lose 50% one period. Obviously, that 50% loss matter twice as much as the 100% gain. There's a nonlinearity in there. This is the math of compounding.
Right.
Of course, that if you think of this as a coin flipping game, you lose 50% or you make 100. So that if you keep doing that and compound that way, you're going to make 0 over time, right? Yeah. But in fact, your expected one period coin toss is an expected return of 25%. So that's kind of weird right there. We have a 25% edge, and this is, by the way, another great example of the roundabout. You and I could flip one coin right now and play that game. I lose 50% if it's heads, and I give you 100% if it's tails, and I have an edge right there. Or whoever gets 100% has an edge, a 25% edge on that one flip. But if we keep doing that over and over again and compound, it's a scratch for both of us. And again, this is really weird. It's if this is your only takeaway, if people who read my book, this is the only takeaway, then I'm tickled about that, because this changes. If people really think about this, it'll change the way they think about risk mitigation, because not all risks are the same.
Well, I actually just want to highlight, because this may not come through. So traditional modern portfolio theory says that you cannot lower risk while raising returns. That's kind of the traditional kind of, in your book, one of the things you said is that Universa's annual return on capital is over 100%, right? And for those portfolios that include, say, a 3% allocation to a Universa, along with a 97% allocation to the S&P 500, they will achieve a 3% annualized outperformance. Now, if that was true, so I guess the question for people, and if I was sitting in the audience, I'd ask, how is that possible? And if that was true, that would put you in the top echelon of hedge funds worldwide. So can you help us understand that? Why is this so rare? And why is it that there aren't more Universas, if this is true, out there?
Yeah, so, well, we had 14 years, we've had a good run, I'll admit that. But at the same time, so you got two things. Our standalone returns are, I kind of wear two hats. So I kind of wear a prop trader hat, where I look at just Universa's returns on a standalone basis. They matter, right? But as I just told you before about that cartoon payoff with a 0 return over the last 120 years, they don't matter that much. What matters more is sort of the inner workings, how my returns work with the returns of my clients. So the whole is truly greater than the sum of the parts when it comes to compounding. If you're just looking at arithmetic returns, they all just kind of add up. But when you look at compounding, it's very complicated. This, by the way, is why all this mathematical machinery is based around mean variance Sharpe ratios, because it's too hard to, if it was all based around compounding, it'd be a lot messier. It requires a lot more thinking. But so, I mean, if you think about the importance of big losses, and the bigger the loss, incrementally bigger the loss, I call it falling off the logarithmic curve, the bigger the incremental loss, the more it matters, the more it matters. You can think of that coin flip as an example. But if you think about that, it shouldn't be that hard to believe that if you can get rid of those really big losses, and obviously if you could do it at a credit, at a profit, it shouldn't be hard to believe that that's going to be the one risk mitigation strategy that raised people wealth over time. Again, contrary to everything taught in business schools, right? Right. If you go for all the other losses, it's going to be really hard to do. You're in the world of diversification, and you're just lowering your returns.
I mean, the other thing is, I think that you've also talked in your book about where risk management actually introduces new risks. Could you elaborate on that? Could you maybe, there was, I think, a story of the SS Eastland or the Titanic. Anyway, but could you just elaborate on how traditional risk management actually introduces additional risks that we don't fully contemplate?
Well, again, it goes back to the cure worse than the disease. It's pervasive. It's particularly pervasive among governments. That's what governments do. They fix things, and very often that cure is worse than the disease, right? But it's easy we focus on errors of commission rather than errors of omission, and we just don't realize it. The SS Eastland is an interesting example. Following the disaster of the Titanic in 1912, there were laws put in place that ships had to have far more lifeboats on board, right? And then 3 years later, this SS Eastland in the Chicago River, because of the weight of these lifeboats, capsized, and more passengers were killed in the SS Eastland than on the Titanic. So this sort of, by definition, this was the cure that was worse than the disease. It's pervasive, just pervasive. We know that. Pervasive in all of capital allocation, though, again, going back to this idea that risk mitigation is never cost effective. Just so anybody who's skeptical that you can't do what I'm describing, lower risk and raise return, there's something called the Kelly criteria that maybe some of you are familiar with. This is entirely what Kelly betting, this is a horse betting strategy, but it's entirely based on the idea that you focus on your geometric average return, your rate of compounding, rather than your arithmetic average return, okay? And it worked beautifully for horse racing. It's much harder in investing. You need to really focus on crash protection to do it. But just to give you an example, a quick example with this coin tossing game. Now, if rather than heads, you lose 50%, tails, you make 100%, let's just cut that in half. Remember, that was for a scratch over time. Now, heads, you lose 25%, and tails, you make 50%, right? So now you've cut your expected return in half. Now it's 12.5% rather than 25 and one flip. But over time, just by betting smaller, rather than zero compounding over time, you're actually going to make a compound per toss rate of 6%. I mean, go ahead and run the numbers. So all I did by betting smaller, we had the exact same payout ratio and the exact same expected return, just smaller, linearly smaller. Your rate of compounding now went positive just by doing that. Now, it doesn't typically work like this in the stock market. You can't just bet less and returns go up because the payoffs aren't that severe. It's much more nuanced. But this is the idea. This is the Kelly criterion idea that you can adjust your bet size or you can focus on different areas of risk and actually be able to raise your rate of compounding even though you don't do very much for your expected arithmetic return on a given toss.
One of the things we talked about is that risk is unfortunately kind of not really an option, right? It's like you're damned if you do, you're damned if you don't. And so then it's really just understanding the actual risk that's taken, and you've kind of distinguish between sort of type 1 type of risks and type 1 errors and type 2 errors when it comes, and you've kind of given that the kind of Neptune-Vulcan analogy that I quite like. Maybe could you just elaborate on that difference between how people understand risk and the differences between those two errors?
Well, the Neptune and Vulcan, that's really more about how mechanical is your risk mitigation. I mean, I don't know if we can get too much into this, but risk mitigation strategies you can think of them on a continuum of mechanical versus statistical. Certainly, we've seen it this year. Turns out Treasury bonds have been statistical risk mitigation strategies, not so much mechanical, because the sign flipped this year. But you're right. Yes. So this idea of really errors of commission versus errors of omission, type 1, type 2 errors. This is as I said before, this is where I think the reason people get this idea of cost effectiveness so wrong, because it's very common for someone to say, well, I'll put a hedge fund or something in my portfolio, and as long as it's making positive returns and it's negatively correlated, it's good, right? So I'm not committing any errors of commission, which would be, if this guy loses money, right? That I just made a mistake in giving him money, right? Whereas an error of omission would be, so I allocated to this guy who made positive returns and gave me negative, lowered my volatility, but the error of omission would be, what I don't see is the other things I could have done. Like it's, you're blind to it. It's like, it's kind of like the Bastiat's opportunity cost, the broken window fallacy. You need to look at the other thing, everything that actually happened is you allocate away from, let's say, just taking risk, allocate it to something that tries to do something about those risks, mitigate those risks, compare, have they done something that has been productive? And this is where I think people just get lost. Again, it's the simple problem of focusing on errors of commission at the expense of errors of omission. So
this strategy, and we're not going to get too deep into it, but this tail risk hedging, which again, you've been employing at the university for the last 14 years, and you've been doing this with your partner and former professor, Nassim Taleb, who was actually, I don't remember if it was the last conference that we were here or the conference before, but you guys pretty much invented the asset class. How have the way investors perceived the strategy evolved from when you were doing this way back in the 90s to today?
Yeah, so that's a really important question, because the way things were for us back in the 90s is people really looked at us as that prop trade more than anything else. So, and it makes sense because this is, for instance, our returns, Universa's returns, standalone returns, have been the most scorned 100% average annual return that you'll ever find, right? People don't want to pay off like mine. It's a lumpy payoff. So it made sense that there's edge in what we do, and we've certainly proven that over Universa's life to date. But I think the evolution that we saw is it became much more of a strategic allocation, and this is really important, really, to get what we do. And you need to look at us holistically with the whole portfolio. But I think it makes a good point on the difference between strategic. I kind of touched on it earlier. The difference between strategic risk mitigation and tactical. I think we tend to think so much in terms of tactical, like, so, which way is the market going? What should I do next to play this? And this is just how people get this so wrong, simply because forecasting the market is impossible. Any risk mitigation strategy that requires a forecast is just simply doing it wrong. I mean, I would argue that to simplify what the point of risk mitigation should be, it should be not so much to protect you from the market, but it should protect you from mistakes that you would make in response to the market. Right. And to keep you away from trying to be tactical and just screwing it up. I mean, you can see it. The whole world gets bearish when the market's down. The whole world kind of flips when it's up, and it gets people. The market is brilliant at getting people on the wrong side of these things.
So I think, again, in summary, what you excel as is sort of introducing this insurance strategy, a tail risk hedging strategy. Now, AQR has been very critical of this tail risk strategy, and they claim that, or at least their research claims that it costs too much and it's not as effective. What do you say about that? What are the actual limits of your strategy?
Yeah. So what you're referring to is kind of funny. I mean, when I read that type of literature, I look at what it is that they're testing, and I think to myself, well, I would sell that. I agree. I agree with that. So that's the problem is, it's hard to use this term tail hedging because the people who do it, there's no real agreement on what that even means. And it gets to the point where among this group of what someone might call tail hedgers, in many ways, they're more different than they are alike. So you can't just say tail hedging. You need to be more specific about how someone's doing it. And in the case that you're referencing, they're testing something that's just not a tail hedge. It's long dated. It's too long dated. It's too short dated. Interestingly, they stayed away from the middle area that would have been much more interesting. Yeah. So these things are straw man arguments. I welcome them. I agree with them. Because again, these are trades, they're identifying something that does really poorly, and these are things that we typically sell sort of as a funding trade against things that we do on the other side.
I'll come back to the strategy in a second, but one of the things that a bunch of the speakers had brought up is that we live in a sort of an economy that is being engineered in unprecedented ways. And the question is, do central banks have the ability to thread the needle on getting us out of this? It would be interesting to hear your thoughts on that. And I know that this is right on the heels of a conversation where we're not trying to predict, we're not trying to forecast, but it is important, just like, because you are a very active, thoughtful market participant, how do you actually see what's happening, and how would you analyze, what's the analog for what you're seeing in the market?
Yeah, and you can talk about the environment without the landscape, without going into the realm of prediction. Right. For instance, it's clear to me that, what's unique today is that we have central banks, I'll say the Fed, that is pushing the market down. This is very, very unusual. In fact, other than December 18, this is an anomaly in modern economic history, modern investing history, that we actually have a Fed that's actively pushing the market down. Business cycles haven't worked this way. Typically, when the market's falling, likely moving into recession, you have a Fed, global central banks that are actively trying to stop it, not trying to push it. So I think this time is completely different. We need to think about it. I mean, I use the analogy that this is, the Fed has been suppressing wildfires for, really since Greenspan in the late 80s, suppressing wildfires. The wildfires, this is the point of my major point in Dow Capital. Wildfires are this natural, healthy, homeostatic process of the forest ecosystem. They're really, really important to the growth of and natural progression of forest ecosystems. And forest rangers have this habit of suppressing them, thinking that they're bad, right? And this is a perfect metaphor for what has happened since the Greenspan era, putting out wildfires. But you find yourself doing enough of that you're in this position that truly fires are dangerous. Right? 20 years ago, 30 years, they weren't that dangerous, but today they are truly dangerous, and we are in a tinderbox, and now we find the Fed really creating these controlled burns, which I think is the only way to describe what's happening today. It is a controlled burn. It's not an organic, out-of-control wildfire. It is a controlled, entirely Fed engineered sell-off. And this is why it's unique in many other ways. You can look at volatility, credit. It's been very orderly compared to other ones. And that's, like I said, it hasn't moved into that out-of-controlled wildfire regime yet. So we have regime 1 and 2. So I think to just identify that, I can't predict if this controlled burn regime is going to move into regime 1, the out-of-control wildfire. I don't have any insight on that. I know the danger's there in the same way it would be for a forest ranger. It's hard to say if it's going to happen. We'll know it when it happens. The litmus test will be things like vol finally going out in a crash, and it will be central banks doing something dovish that actually doesn't stop the market. Like anything dovish, I think by the Fed today I think we can all agree the market would rip on that. We can argue what would happen after that, but so we know what regime we're in, regime 2. But the day could come when the Fed tries to stop a falling market and isn't able to do it. And now we're right back to the traditional asset bubble popping. But we need to recognize that everything is different this time. And I think that the big reason is, of course, the debt is so big that you can't compare this tightening cycle to any other one. Because I would argue, I've been critical of the Fed for my whole life, but I would argue that popping this bubble this time is just not something that's feasible.
I'm going to take a total non sequitur. Total. If my research is correct, I believe you own and run an award-winning goat farm, and you make goat cheese. And I think the farm is called Idle Farms. Do I have that correct?
That's right. Yeah.
So just maybe again, this is a slight non sequitur, but I actually think this has a point. Can you maybe just tell us what a hedge fund manager is doing running a goat farm or being a goat farmer, and what analogies you might draw from goat farming to risk mitigation, markets, whatever you wish?
Well, it is very similar. And I can't take credit. I have great people that work there. So
that run the goat farm. So you wouldn't call yourself a goat farmer?
I like to go there, and I like to walk the woods with the herd. I do that, but
Okay.
there are people that, so it's something that we built. My wife and I built it. It was nothing when we started it. So we'll take credit for that.
Okay.
It's something that's very gratifying. It's something that's more tangible, unlike what hedge fund managers do day to day. But it's more similar than that because we objectively make some of the best goat cheese in the world based on awards. And I think that what's special about what we do is we have this practice where on a daily basis, we move the herd around with this electric fencing every single day to a different area. It's called managed intensive grazing. And it's actually a really important practice. It's gaining traction. I hope it becomes the norm. And of course, what you're doing is you're mimicking what a herd would have done many, many years ago. They stick together because they have predators around them. They move around. They don't want to feed where the excrement was, right? So they move they're always moving, and they're always have predators around them. And listen, this is why movements like this among herbivores are the reason why the Midwest in the United States is the most fertile land in the world. It's because of the bison. So what happens, not only is this good for the goats and their milk, but it's also really important for the soil and the pastures. And I think this is something that people don't quite fully appreciate yet. And there's a whole versus the parts problem here, because people think that ruminants are the cause of a lot of carbon in the atmosphere, and actually the opposite is true. It's only when you take the ruminants and you put them in a contained space and you grow monocultural tillage crops and move and feed them that way that we have a problem, when you separate the parts from the whole. But when you move it all together, this is actually the carbon that we sequester in our soil from these practices is incredible. And I just think that this is something that is hard to see because you need that holistic framing, similar to risk mitigation, I think.
Well, I got a lot more than I bargained for.
I did that?
Yeah, that was great. That was great. All right, I just think we probably have time for one more question. Just when you, at the end of your book, Safe Haven, you end with this notion of amor fati. Could you maybe tell us what that means? What does it mean to you, etc.?
Yeah, so amor fati is love of one's fate. And Friedrich Nietzsche called this the formula for greatness in a human being. And I argue that I think that this perspective is the formula for greatness in investing. We have one shot, right? If you just think of life, life is you're shooting one arrow and you have one shot. But we think so much, and this applies to life, it applies to investing, but we think of this as a distribution that we're trying to sort of optimize, this distribution of arrows, but we know we just get one. And that alone makes you really think about it differently and how you go about doing this. And so much of modern finance is that we think about this shot grouping. It's about getting the precision better. So that's a smaller, tighter shot grouping. That's precision. But modern finance gets it precisely wrong, meaning their accuracy is so poor. Like they're shooting at a bullseye that is optimizing risk, maximizing risk-adjusted returns. They're doing it very well. There's low volatility around this thing that makes you poorer. So it's about being precise but inaccurate. But I argue that what we should be thinking about in investing and beyond is the precision and accuracy. You're able to get both. So careful. They say be careful what you're good at. Be careful. In this case, be careful what you're aiming at. You just might hit it.
Can you say that you love your fate so far? And maybe what have you done to make it so?
Yeah, so certainly. I mean, in investing, I think the way to do that, we've had a lot of luck. The markets have experienced a 100-year crash every few years since we started, right?
Yeah.
Funny how that's worked. But we didn't have to have that happen. So it wasn't necessary for us to get that. We didn't have to have any crashes. I don't want there to ever be a crash again. I suspect there will be, but I don't need there to be just because of the way we go about optimizing and the way we fit in with our clients' portfolios. We actually allow them to take on more risk because we're there. So what does that do? It makes you more robust to the different fates that you might see. And that's what we've experienced so far at Universa.
Mark, that was great. Cannot thank you enough for flying up from Miami to join us here. And I know you're flying right back, but it's been such an honor and a pleasure. Been reading your stuff for years. And really, first of all, on behalf of the cause, on behalf of us and all of us, we thank you. And we have a small token of our appreciation that we had a little art piece that was commissioned with all of Mark Spitznagel's favorites. Right. Do we have goats on there? Yeah, that's so we'll take a little picture.